Happy New Year, everybody, and welcome to our quarterly AFC Fund webinar. My name is Thomas Hooker, and I'm the CEO and founder of Asia Frontier Capital. With me today are Ruchir Desai in Hong Kong, who is managing with me the AFC Asia Frontier Fund. Ahmed Tabaqchali, the chief strategist of the AFC Iraq Fund, is today in Baghdad, Iraq. Scott Osheroff, the chief investment officer of the AFC Uzbekistan Fund, is in Tashkent, the capital of Uzbekistan. And Vicente Nguyen, the CEO of AFC Vietnam Fund, joins us from Ho Chi Minh City. This webinar will last about 45 minutes, and thereafter you will have the opportunity to ask questions during our 15 minutes Q&A session after the presentations. You can submit your questions online through the Q&A icon at the bottom of this Zoom video on your laptop, PC, or mobile phone. 2023 was a good year for AFC, since all our 4 funds had a positive performance. Our AFC Iraq Fund was last year with a performance of plus 110%, the world's best unleveraged traditional long-only equity fund. Congratulations to you, Ahmed, for this great achievement. I'm really very happy about this. Also, our AFC Asia Frontier Fund had with a plus of 27.1% a great year and the best yearly performance since the inception of the fund back in 2012. Declining interest rates in some of our countries, especially in the second half of 2023, and the historical low valuations in our markets contributed to this solid performance. But as Ruchir will tell you in a few seconds, we still have a positive outlook for 2024, since these positive factors are still in place this year. Additionally, and also important, our AFC Asia Frontier, for example, still trades at an undemanding low PE ratio of only 6.8 times, which is very close to the all-time low. Ruchir, over to you for the Asia Frontier market outlook, please.
Great. Thank you, Thomas, and welcome everyone to our webinar, and wish you a happy new year and all the best for 2024. 2023 was a great year for Asian frontier markets and also for the AFC Asia Frontier Fund, as Thomas mentioned. And I'll just walk you through what drove performance last year and what the outlook is for 2024 and some of the big trends in our markets. So if you can go to the next slide, Peter. Yeah. So as you know, Thomas mentioned, performance was great. It's the best annual performance for the fund since inception in 2012. And as the chart on the top left shows you, performance was, basically performance outperformed pretty much all the major global indexes, but more importantly, outperformed most of the Asian emerging markets. I would say pretty much all the Asian emerging markets. So Asian frontier markets as an asset class, really shows that the returns can be generated, or you can get performance in these markets through stock selection, country allocation, and that was reflected in performance last year. And also, it just wasn't performance for last year. I think if you look at the chart on the top right, over the last 3 years, on an annualized basis, performance has been pretty decent as well, and it's outperformed, again, major Asian and global indexes, especially, for example, the emerging market index as well as the MSCI ASEAN index. So, for example, many people talk about Southeast Asia as a great investment opportunity. I'm sure it is. For example, Vietnam is part of Southeast Asia, and we really like that story. But besides Vietnam, as the ASEAN index shows, hasn't performed. So what I'm trying to say is that Asian frontier markets as an asset class, there are many attractive and interesting stories like Bangladesh, Pakistan, Sri Lanka, Vietnam, and also Central Asia, Uzbekistan, Kazakhstan, and Georgia, which I think are still under-researched and undiscovered compared to, say, an Indonesia or a Malaysia or a Thailand. And I would say some of these ASEAN markets probably are quite mature now, for example, like Thailand or Malaysia. So pretty strong growth prospects for Asian frontier markets, which is reflected in the performance of the Asia Frontier Fund over the last couple of years. And just from a performance contribution perspective, as Thomas mentioned, our AFC Iraq Fund was up about 110% last year. And we've got exposure, the Asia Frontier Fund has got exposure to Iraq via the Iraq Fund. So that helped quite a bit with performance contribution. About 40-45% of performance came from the exposure to Iraq. But besides that, it wasn't just Iraq. So more than half of the performance also came from the other markets like Kazakhstan, Sri Lanka, Pakistan, Vietnam, Georgia, and Cambodia. So very, very broad-based performances. It wasn't just one country or two countries or just a handful of stocks which drove performance. So that's very good and very important point to note. It was very diversified and very broad-based performance across our markets. So a very strong year overall. I think the outlook is still quite promising, which I'll talk about later, but I would suggest that you could probably read our review and outlook report, which I put the link for in the presentation. So the PDF will go to all the listeners, and you can probably view the report, which gives an overview of what drove performance and what the outlook is going forward as well. If you can go to the next slide. And as I was mentioning, Asian frontier markets had a very strong year. So just very briefly, this chart shows you the strong performance pretty much across all our markets, and basically significant outperformance against almost all Asian emerging markets or markets in the region. So it once again signifies not only the investment case for Asian frontier markets, but also the diversification opportunity that it offers to investors. So for example, if you had some allocation to Asian frontier markets last year, you would have done pretty decently given the fact that China underperformed and many Southeast Asian countries underperformed. Of course, India did pretty well. But besides India, not much else in Asia did well outside of Asian frontier markets. So that's just a snapshot over here. And I'll just talk about what was key driver for performance on the next slide. So I think one very important factor was everyone's talking about the Fed going easy on interest rates in 2024. But more importantly, I think in our markets, we already saw interest rates getting cut in our markets last year, especially second half of 2023. I'm just taking a step back and putting it into perspective. 22 was very, very rough for Asian frontier markets because they had to face an aggressive Fed, plus some of the countries like Bangladesh, Pakistan, Sri Lanka had macro imbalances, so they had to raise interest rates even further, even more aggressively, given they had the high commodity prices, and they had a lot of imported inflation from high food and fuel costs due to the war in Ukraine. So they raise interest rates very aggressively, I would say more aggressive than most central banks globally. And so that gave them, once things stabilized at the end of 2022, beginning of 2023, inflation started coming off. And probably I would say the Fed also was done with their most aggressive hiking cycle at the start of 23. That gave central banks in our universe some room to, begin easing, because inflation came down quite significantly. As you can see on the chart on the top left, inflation in Sri Lanka was at 70% at the end of September 2022. Now it's down to about 4%. And even the other countries like Kazakhstan and Georgia have seen inflation come up quite significantly, while Vietnam's inflation has been pretty manageable at less than 4% over the last about 15 to 18 months. And that's led to a pretty aggressive interest rate cut cycle in our markets since the probably second half of 2023. So as you can see on the chart on the top right, Sri Lanka has cut interest rates by almost 700 basis points. And even Vietnam, Georgia, and Kazakhstan have begun the easing cycle. I think the next to begin the easing cycle will be Pakistan in the first half, and they will also cut interest rates pretty aggressively. They've raised interest rates from 7% to 22% in a matter of probably 24 months. So as inflation starts easing there, you will see probably a pretty aggressive easing cycle in Pakistan as well, most likely second half of 2024. So I think the two key factors which drove positive investor sentiment in our markets and performance in our markets was the easing of interest rates, easing of inflation, and broadly just the stabilizing of macroeconomic positions in many of our countries. And besides that, I think this was supported by very discounted valuations. So for example, as we began 2023, the fund itself traded about 6.5 times P ratio, and many of our markets were trading at single-digit P multiples. So you had bottom valuations, economies had bottomed, and as things started improving, there was we were not surprised by this whole re-rating that happened last year, and we've been talking about it pretty much in all our webinars. And also at the beginning of 23, we mentioned that we would not be surprised if we saw a strong re-rating in the fund, given the fact that things had bottomed out. And I'll just talk about the outlook going forward now. So I think though performance has been very strong in 2023 for the fund with 27.1%, and also for Asian frontier markets as a whole, a very strong year in 2023. I think for 2024, the outlook is still quite positive, as I'll talk about in the following slides. So if you just go, yeah. So I think the couple of factors which I believe which makes me confident that the outlook for this year also is still quite positive and momentum will continue. So a couple of factors. One is, though central banks in our universe have cut interest rates aggressively, I think there's still a lot of room for many of the countries that I mentioned. there's still room to cut interest rates because inflation has come up quite significantly, and real interest rates, for example, are still quite high in markets like Sri Lanka or Kazakhstan or Georgia. And as I mentioned, Pakistan has also got room to cut interest rates now. As the chart on the top right shows you, interest rates probably are basically at an all-time high of 22%. So I would not be surprised if they cut interest rates by about 600 to 700 basis points in 2024. And that will be a big driver for performance in Pakistan. Historically, when the interest rate cycle turns downwards, the stock market sees a pretty strong rally. So I think that's going to be the next stage of performance for Pakistan in 2024. And broadly, I would say, I think the US Fed also, broadly, I think the market expects the US Fed to begin cutting interest rates next year. Now, I don't know whether it's going to be in March or June or second half of 24. But the bigger picture is that broadly, the US Fed and also I would say global central banks, their stance is moving to a less hawkish stance, and possibly many of them will begin cutting interest rates in 2024. That's the main message I'm going to say, that the trend towards a less hawkish central bank policy from many global central banks, as well as possibly even cutting interest rates, is going to be very positive broadly for frontier and emerging markets, because this was the key headwind. High interest rates from the US Fed, a stronger dollar, were the key headwinds for emerging and frontier markets 2022. But as this trend reverses in 2024 at some point, then this will be very positive for investor sentiment, and that will help central banks pretty much across the globe, and also especially in our markets, to manage their monetary policies in a more comfortable fashion. So I would say this will continue in 2024, and this will be a supporting factor for positive momentum in our markets. And also, I think another important factor on the next slide is the earnings recovery. So last year was a tough year, just in terms of earnings growth, pretty much in all our key markets like Vietnam, Bangladesh, Pakistan, Sri Lanka. Central Asia had pretty good earnings growth last year. But these four countries have had a tough time in terms of earnings recovery in 2023. So I think 24 with economic growth recovering, plus interest rates coming off, so that'll be a big reduction in finance costs for many companies, and broadly for the market as well, it's going to be positive. So earnings recovery, I think, will be very strong in 2024 for countries like Bangladesh, Pakistan, Sri Lanka, and Vietnam, given the coming of a low base. So you will have this positive momentum as well, and these indicators for the investors as well. So we should drive positive sentiment as well, and support, I would say, the continued momentum in Asian frontier markets. So I think these two factors are very important for, maintaining the momentum in Asian frontier markets. You have lower interest rates, you have earnings recovery. So I think these two factors coming together, as the next slide shows you, will be the key driver for, re-rating valuations further, or re-rating the market further. Because I think, we've not had these very important trends for some time now in our markets. For the last couple of years, you had, high interest rates, high commodity prices, macroeconomic imbalances, earnings going down. But what's happening this year is you're seeing interest rates coming off, you're seeing earnings recovery, plus you have discount valuations, or still discount valuations despite a strong performance. And I think these two trends coming together will be very important tailwinds for our markets, and then this will be very important for re-rating our markets in 2024. So in my view, 2022 was the bottom for Asian frontier markets. 23 was the rebound, and 2024, I think we'll continue to see the momentum across our universe this year. So I'm quite confident that this, strong performance, so it's broadly just this general positive momentum continues in 2024. So these are the three important factors, like I mentioned, which should be very important for our markets going forward over the next 12 months or so. And then on the following slides, I'll just talk about some of the important trends which I've spoken about before, and we've written about before in our newsletters as well, in terms of some of the key countries which are benefiting from some of the global trends or global geopolitical shifts that are happening in the region. So of course, Vietnam is one of the key beneficiaries in our country. I mean, in my view, Vietnam is the key beneficiary in Asia from the global supply chain shift. So I don't think any other country has benefited as much as Vietnam since the trade tensions and geopolitical tensions began between China and the US in 2017. So as you can see on the chart on the top left, foreign direct investments have been extremely strong. In fact, they've been growing. And last year in 2023, they had the highest ever FDI that the country has seen, at about 5% of GDP, which has been very consistent. So it's amongst the highest as a percent of GDP in the region. And despite the slowdown in the US and Europe and stuff and things like that, still saw very strong FDI inflows. And most of, I would say almost 70% of this is coming into the exports, the manufacturing export sector, which is meant for exports. So that's very positive for Vietnam's long-term exports, despite exports being weak this year, as the chart on the top right shows you. So yeah, I think this is a very important trend that's happening in the country, and the relations with the US only getting closer, especially post tensions between China and the US. So for example, Vietnam's exports to the US between 2017 to 2023 have almost tripled because of tariffs on Chinese exports to the US, and that's led a lot of manufacturing activity move into Vietnam. So Vietnam is the key beneficiary in Asia from the global supply chain shift. Plus, they have access to a lot of free trade agreements with Europe, with the UK. They're part of the other Asian free trade agreements. So they're just very well tuned with this whole trade cycle, and the exports is about $350 billion a year. So extremely well positioned to take advantage of these global trends. And as the next slide shows you, it's not just Vietnam, even Bangladesh is benefiting, but more focused on the garment sector. Vietnam is more diversified on their export, but Bangladesh is very focused on garment exports. They're now the second biggest garment exporter globally after China. So they've taken a lot of market share from China over the last 5 or 6 years. And as the chart on the top left shows you, their garment exports have been pretty resilient despite a slowdown in the US and Europe. So exports in the year ending June 2023 grew by about 10%. So pretty decent given the fact that other countries like Vietnam and Pakistan, Indonesia, showed negative export growth for garments in the same period. And also, like I mentioned, the trade tensions between China and the US have led to a lot of manufacturing activity leave China and go into other markets like Bangladesh and Vietnam. So the chart on the top right shows you the market share gains in garment exports to the US that countries like Vietnam, Bangladesh, and Cambodia have made relatively against China. China's lost market share, but Vietnam, Bangladesh, and Cambodia, and to some extent India, they've all gained market share. So these countries are gaining market share from China because of the tensions between China and the US. And it's not just South Asia or Southeast Asia which is benefiting, as the next slide shows you. Even Central Asia is benefiting a lot, but more from, as the next slide shows you, but more from the tensions between, or the war in Ukraine. So for example, Georgia is the key beneficiary in Central Asia from the war in Ukraine. As the chart on the top left shows you, they've seen their exports grow quite significantly from about $300 billion, at the beginning of 2020 to about $500 million now. So it's almost doubled, they're about 1.5 times on a monthly basis, because a lot of supply chains are now moving from Russia. Instead of moving via Russia, they're moving via Central Asia, because Georgia also has access to the Black Sea. So for many countries like Georgia, Uzbekistan, and Kazakhstan are benefiting from this whole supply chain shift in the region as well, as the image on the top right shows you. And so Georgia also has benefited a lot from not just export, but also remittances from many people moving into Georgia from Russia and Ukraine, also higher tourism revenues, so that their GDP growth has been on a tear. For example, GDP growth in 2022 was 10%, and in 2023 GDP growth will be about 7%. So very strong growth for Georgia out there. And just broadly, I'll just talk about some of the top picks, which I've mentioned before also on our presentation on the next slide. So these are top picks, basically just a brief snapshot. But more importantly, pretty much all these companies contributed to fund performance last year. So I think I would say most of these companies did very well, and they contributed very strongly to fund performance in 2023. But despite some of these stocks doing well last year, many of these companies, for example, still trade a very attractive valuation. As you can see on the 2024 PE column, most of these companies trade at pretty much less than 10 times, and even the ones which are more than 10 times are trading at not exorbitant valuations like 35 or 40 times, but around 15 or 16 times. And more importantly, like I mentioned, earnings growth is going to be very strong. So as you can see, earnings growth for these companies is expected to be pretty strong next year. So I think, like I was mentioning earlier, this ties into my earlier comment that 2024 will be driven by earnings recovery and discount valuations, which is supported by lower interest rates. So this all ties into my top-down comments that I made earlier in the presentation. And so I just want to wrap up with the key takeaways from my message. on the next slide. So I think, yeah, so broadly, like I said, valuations are still very attractive. The AFC Asia Fund trades at its all-time low P ratio or close to its all-time low P ratio of 6.8 times, despite a very strong performance. Because earnings have been strong in some parts of our universe, for example, in Central Asia, while they're recovering in Bangladesh, Pakistan, Sri Lanka, and Vietnam. But fundamentals are very strong. Long-term earnings growth is about 17, almost 18%. Return on equities are very strong. Our companies are not leveraged at all, very, very low leverage. So broadly, I think 2023 was very strong for our markets. And like I said, I think I'm positive for 2024 as well. I think most of, like, for example, many of the key headwinds, or I would say almost all the key headwinds that impacted our markets over the last 18 months, like high interest rates, high inflation, are now becoming tailwinds. And I think those will continue in 2024. So I think Asian frontier markets are very well placed. But from a performance perspective, I think countries which are coming off from a low base and are seeing a recovery this year, for example, Bangladesh, Pakistan, Sri Lanka, I think these countries can show outperformance in 2024 against some of the other Asian frontier markets, or broadly other markets in Asia, because they had a very tough time in 2022, and even till the first half of 2023 had a very tough time. But now the tide is turning. Their macroeconomic imbalances have been sorted out. Their interest rates have come off or will come off. Inflation's coming off, and earnings will recover. And valuations in these countries, all three countries, are very discounted. So I think broadly, I'm positive Asian frontier markets, but from a relative performance, I think these three countries can outperform. So overall, yeah, still positive for 2024 for Asian frontier markets. And I think I think my calls at the end of 22 was to look at Asian frontier markets as an investment opportunity, because things had bottomed out and last year was good. And my call is that 2024 should be pretty decent as well. So with that, I think I'll hand over to Ahmed Tabaqchali, who is the chief strategist for our AFC Iraq fund. Over to you, Ahmed. Thanks.
Thank you, Ruchir, and thank you everybody for joining in and joining us in this webinar. Can I have next slide, Peter? Well, as Thomas said, and as Ruchir has highlighted, the fund had a phenomenal year. Last year, as you all heard, we were up 110%. And the thing is, as wonderful as that performance is, and as we're thrilled with that, however, in a sense, the performance is consistent with what we expected when we launched the fund. Iraq, and the reason why I say it's expected is Iraq is a country that's emerging from post-conflict and catching up with the world. So potentially Iraq could be a multi-bagger, but let's leave that for a second and come in to say why we believe that it has that kind of return potential over time, over a long-term strategy. Well, first of all, as some of you might know, or would know from the news, Iraq always features whenever there is a negative development, whenever there is a conflict and so forth. And that's in a way consistent with this history of over 4 decades of conflict. You're talking from the first conflict that began in 1980s. A brutal war with a major neighbor, followed by a short a year or two of breathtaking, and then bang, invasion of Kuwait and the first Gulf War, in which the US sort of pretty much destroyed almost all the infrastructure that was not destroyed during in the prior war. And then followed that by a period of 14 years of one of the most brutal sanctions you've come across. Anybody who looks at Iran sanctions or looks at Russian sanctions, in fact, they don't even compare anywhere near the sanctions that Iraq has witnessed during that time. That was followed by the US invasion, and as well as by civil war. And as soon as the civil war ended, we had 2 or 3 years of, let's say, catching up with the world, and then we had the ISIS invasion, in which a third of the country was taken over, and oil prices crashed. So basically, the thing is, the whole investment thesis of the fund is predicated and looked at 2 of the main drivers that would drive Iraq's performance going forward, and that was always in the fund strategy. The first one was basically the peace dividend. As the country moves from conflict towards peace, there's a huge peace dividend. And we've seen that in markets like Sri Lanka, where you've had the market was almost up, I think, 250% or so after the end of conflict. But with Iraq, there was something else as well. During those 4 decades or so of conflict, Iraq was completely isolated from the world. So pretty much miss out on almost all the developments that we now take for granted. So for example, like banking, using banks and online payments and so forth. Also, for example, internet, although quickly after 2003, we sort of caught up with the world, and currently we have a penetration of over 100% in internet. But in a sense, mobile internet is really still in its infancy. 3G was only introduced in 2015, and then we had 4G, I think was last year or the year before. So those were the two drivers that drove that, and that what drove the fund strategy. In a way, we pretty much hold the same stocks that we have held since the fund's formation, and that's to focus on those drivers of the market. One of the drivers is, as I mentioned there, two of those drivers came to fruition this year, and that is what drove the performance there. Those of you who've took part in our prior webinars and maybe read the Iraq newsletters in the past, I mentioned one of them is the return of stability. Stability has, I understand that, last 5 years might not be in most people's mind stability, but for Iraq, the last 5 years are nothing compared to what Iraq witnessed in the years before. But crucially for us is that, yes, there is always the threat of violence. Yes, there's always the issue of something can go wrong, especially with the current conflict in the Middle East. But the cycle of violence feeding upon itself has pretty much ended as far as Iraq is concerned. And that, for Iraqis, both individuals and businesses, has changed the mindset completely. And I try to highlight it in a number of articles, but basically the main of them is it's unleashed over the last two and a half years, unleashed a massive investment, capital investments in infrastructure. Those of you who might see Baghdad or look at it differently, Baghdad is going through a transformation that I have not seen since the early 80s. Those who might have been in Dubai in 2005 and 6 and seen transformation, Iraq is witnessing something like that. On a scale, I'm not going to compare it to Dubai. Two countries are different worlds, different timelines. But in terms of a city of a population of 9 million that has the same infrastructure, a population that was almost 3.5 million, you're seeing a massive explosion there. I live in Baghdad and I continuously go to new roads and see, oh my God, I don't recognize this neighborhood anymore. There's new buildings building on and so forth. So that was one of them. The other one was the currency's turmoil. In which the Central Bank of Iraq changed the procedures for cross-border transfers. They eventually released more and more regulations, changed more and more updates. The upshot of them was it strengthened the banking, it accelerated the adoption of banking and the use of the bank in Iraq. Until very recently, cash accounted for something like 85% of transactions. That should give an idea of how small the banking system is in Iraq. These measures have accelerated adoption of banking. Can I have the next slide, Peter, please? I apologize for that. Yeah, so that accelerated adoption of banking. And with that, it benefited the top quality banks. And the benefit, you can see it in the two charts on the right-hand side corner. The first one on the top right-hand corner is the one in trailing 12 months earnings. I've used normalized trailing 12 months earnings, and you can see they began in late quarter of last year. They've already been growing strongly for many companies, but they've accelerated and went forward. Now, for same thing with the valuations caught up again. So basically, what you have is the valuations are still very, very attractive for all of these banks. They're all under 10% PEs, but now they have earnings momentum pushing that forward. And I expect going forward in over the next 12 months and probably even much longer time frame, I expect that to continue because as a banking system, we are still, as I mentioned to you, banking sort of done about 15, maybe it's now 20% of financial transactions or for economic transactions through the banking system. So there's a long way to go, and it will unfold over time. Now, obviously, this kind of earnings growth will slow down from the prior years because you're going to have, next year from now, a year from now, you're going to have tougher comparisons, and therefore you're going to have slower growth. But it'll be slower growth, slower versus the current, breakneck growth, slower growth, but from a much higher base, which should support the earnings of these banks going forward. And we see that trend in its infancy. If I can have the next slide, please, and then I would end my part. The next slide basically is to argue that, yes, I've mentioned the fundamentals driving the market's performance and our outlook for them, but also you should take into account the market's move in context of its own history of we've had a 7-year bear market, almost the biblical part where you have 7 lean years and 7 wonderful years. We are just in the early stages of our wonderful years. We've had a 7-year bear market in which by the market was completely shredded. And if you look at the numbers there, I mean, year on year, there. But for us, we saw an opportunity and we came into it and we're beginning to benefit from that. But in a sense, the market is in early stages of that. We anticipate that the market would catch with this prior peak of early 2014 and to rally further from there as these fundamentals unfold over time. Would they unfold over a year, 6 months, 2 years? The outlook is they're unfolding, and that's the main thing. And we believe in that will catch up with that. Finally, I would say that the market still, after all this rise, looks incredibly attractive, in spite of all the risks that are out there for Iraq. Still attractive compared to other global markets, and you can see on the bottom hand side chart there. For the month as of right now, the market is up about 0.6%, and the fund is up 2.8%, or estimated 2.8% as of today's close. So with that, I thank you for your listening, and I pass on to my colleague Scott, who looks after our Uzbekistan fund. Thank you very much.
Thank you, Ahmed. Hi, everyone. Sorry, my internet's not great, so I won't be on video. Next slide, please. So in Uzbekistan last year, there wasn't a whole lot of news flow. The economy grew about 5.5%. So again, it's chugging along. But finally, we're starting to get a few catalysts on the horizon and some that are already beginning to play out. So hopefully this continues and we see more of this throughout this year, which makes it hopefully more exciting. So to discuss a little bit about what happened in December, we saw 2 IPOs. They were state-owned entities. These are the first big ones to really IPO, something that we've been talking about for a few years. They were small issues. I think it was about $3.5 million combined of both Uzbek Invest, which is the largest state-owned insurance company, and then Uzbek Telecom, which is the biggest telecom company in the country. Uzbek Telecom was 131% oversubscribed, and Uzbek Invest 128%. So this brought roughly 11,000 new investors to the market, which is great. Again, something that we've been talking about for years, which is that the government needs to privatize some SOEs, create some easy wins for investors, to get some appetite going, animal spirits, and bring more money and investors into the markets. So this is what happened. And of these two, Uzbek Telecom is down a little bit, about 10% since the privatization, and then Uzbek Invest is up 45%. So not too bad. Full disclosure, we didn't invest in either of these. We looked into each of them, but we found that our capital was better allocated into other companies that give us better leverage to economic growth in the country. So we'll keep an eye out for future privatizations, but nonetheless, it's great to see that there's 2 new listings on the market. They were well received, and they brought in a handful of mainly retail investors, mainly local investors to the market, which is what's really, really needed. So that's positive. Later this year, another catalyst in terms of privatizations, Uzmed Kombinat, which is the fund's second largest holding at present. The plan last year was for the government to do a secondary offering, but it got delayed. So hopefully in the first half of the year, we start to see that, along with some institutional investors which come in and partake in that offering. So next slide, please. And just to continue on that note of things that we've been talking about for a long time, about 2 weeks ago, there was a delegation between Spain and Uzbekistan that met. And again, what we've been talking about for a long time is that we want to see more capital come into the banking sector here because there's a huge shortage of capital in the financial system, just a result of the country growing so quickly. And the cost of capital right now is in the mid 20% range. And we want to see more capital coming in from abroad, and that's finally beginning to accelerate. This was always an issue under the former president because they were very protectionist. They didn't want Russian banks to come in because the banking sector here, when we got here in 2018, was about $30 billion. Nothing, for all intents and purposes. But since we came here, we've seen that TBC from Georgia has been issued a license. Halyk Bank from Kazakhstan has been issued a license. last week, Eurasian Bank, which is a mid-sized Kazakh bank, private bank, by the way, they received a license from the Central Bank of Uzbekistan. So they're going to start doing business here. And then as part of this delegation, where the Uzbeks met the Spaniards, there was discussion that Santander from Spain is looking to potentially come to the market and start with building a loan book up to $500 million. So again, as we see more capital come into the market, and slowly but surely as the cost of capital comes down, we should see interest among locals move from, say, term deposits to corporate bonds and in due course equities themselves. It's a multi-year process, but again, it's moving in the right direction. A bit slower than we would have liked, but nonetheless, it's happening. Another big catalyst, which we'll see how it impacts the capital markets this year, is on the 5th of September, there was a presidential decree, which I wrote about in our September update, where the president signed a decree on the further development of the capital markets. So I've mentioned there's this big piece of capital markets legislation sitting in Parliament, which will be passed in due course. But in the meantime, they're looking to accelerate a few things. One of them is effectively quasi-tax breaks for Uzbek employees. And what it states is starting from this year, an Uzbek can invest the equivalent of either 1 month of their salary or up to 100 million sum, which is roughly $8,500 US, into the capital markets, into fixed income or equities. They have to hold these positions for at least 1 year, but they can invest them in lieu of paying income tax, which of course is a no-brainer to make some investments, own some assets, rather than paying to the tax man. The big question for this scheme is going to be how well is it marketed? The jury's out on that. I've spoken with some people that have companies here that are interested in it, but in terms of broad adoption, I think that's going to have to come from the government. So hopefully throughout this year, we see some news on that, because that would be a big boost to the local capital markets, capital that would otherwise be paid to the government for taxes. So, and as we discussed before, it's not going to take a huge amount of money to move this market like we saw it in 2020 and 2021. So nonetheless, we remain optimistic. Everything's moving in the right direction. It's really a timing issue, but some of these things, the IPOs, new banks getting licenses to come to do business here, items like this, in regards to taxes, are all very positive developments. So with that, I'll pass it off to Vicente and Nguyen, who will be discussing Vietnam.
Thank you very much, Scott. Peter, can you go to the next slide? So if you look at the charts and you follow our previous webinar, you already understand that Vietnam really had a very hot year, very difficult year in 2023. So at the first quarter, the GDP growth was only 3.3%, and then it's improved to 4.1%, 5.3% in the third quarter, and finally in the fourth quarter, the GDP growth reached 6.72%. What we can say in this chart, that the worst situation, the worst periods of Vietnamese economy that was over. This is completely approved by this chart, and the National Assembly just already approved the new targets for 2022, that the GDP growth around 6%, and many international financials institutions also forecast about a Vietnamese GDP growth in 2024 is around 6 to 6.5%. So at the beginning of the year of last year, because of the weak consumption all over the world, especially in US and Europe, because of the high inflation, the consumption was down aggressively. So the export of Vietnam also decreased very strongly. However, the government started to spend a lot of money to push the economy up, and it's really, really worse. Go to the next page. If you look at this chart, you can see that the GDP come from most likely from the public investment. So when the government saw that the economy is in right very difficult time, they already approved a very giant investment package, and they spend much more money into infrastructure. They build airport, they build highway, they build bridge, electricity, power, and a lot of stuff. And by this way, it's created job and push the economy up. Another thing, it also support the GDP in 2023 is tourism, because in 2022 we almost had nothing. However, last year in 2023, more than 11 million people came to Vietnam. It's contributed around 11 to 12 billion US dollar, and it's really support for the whole economy. So actually, government has to spend a lot of money, not only in last year, but also in this year and next coming year. The reason why we are right now allocate our portfolio into the public investment who can benefit a lot from this trend. Go to the next, please. And exports is a big issue of Vietnam economy, because export contribute around 100% GDP with nearly 400 billion US dollar. And in the first 8 months of last year, the exports growth was very terrible. If you look at it in the April, exports growth dropped 17%. However, you know, people cannot stop eating, wearing, or something like that. And they started to buy stuff again when the economy become more stable. And the exports growth from Vietnam started to recover in September, October, November, and especially in December, when the export growth jumped 13.1%. So we forecast this kind of thing, and we think that in 2024 export continue to recover very strongly. And the reason why we also allocate our portfolio into export sector, a lot of company was in our portfolio, like government, textile, seafoods, or furniture. They had a very bad year in 2023, and when the revenue tumble, profit tumble, share price tumble, and most of them are traded below book value. The reason why we collect it, and we're waiting for the recovery. So I'm very confident that in 2024 those companies will recover with much better revenue and profit. Actually, it's already proved in the fourth quarter, when most of the company already expect they have a much better performance in the fourth quarter of 2023. So go to the next, please. And another thing I think is really support for the stock markets is the interest rate. So last year in December of 2022, the interest rates went up aggressively, and it's really killed the market. However, after the government intervened the market, and it pulled the interest rates down, and right now the deposit interest rate is declining aggressively to around 5%, and some banks even offered the interest rate around 3% only. So this is really help the enterprise to improve their earning and support for the citizen to consume more, or the enterprise to expand the business for investment or anything, and especially for the stock market. So I think the stock market is supported quite positively by the declining interest rate. Go to the next, please. So what is the focus for 2024? So actually, most of the big broker in our country forecast that the index may jump around, it will increase around 13% to 28%, and on average, we make this calculation. The average forecast around 19.5%. It means the index may close at 1350. So I think that 2024 will be a strong year for the whole market, and I think that AFC Vietnam can capture this crowd and we can have a good year in 2024. So thank you very much.
Thanks everybody for your, as always, interesting and insightful presentations. We will now answer some of the many questions we have received from the participants, but you can still submit more questions during this Q&A session through the Q&A button at the bottom of the Zoom screen on your PC, laptop, or mobile phone. The first question we have received is to Ahmed. It's a good question. We have also similar one to Scott. Has there been any tourism starting in Iraq yet, Ahmed?
I think the answer is that yes, it has started. It's been starting for a number of years. Not the most ways that people look at it. One of the ways to look at how much there is and how much potential there is for tourism. Iraq, as you might know, the archaeological history of the country is almost second to none in terms of antiquities, in terms of what is out there. Those specialists know that quite a lot. But also to give you a sense, the receipt, the figures for receipts in the balance of payments, which is mostly spending by foreigners in the country, peaked at around $7 billion in 2019, and then it declined. Last year was up an estimated $9 billion. So where does that tourism come from? One of the largest part, which is unknown, but those who might seen my newsletters see religious tourism. Everybody knows and is aware of the pilgrimage in Mecca. What most people don't know is religious tourism in Iraq is a very, very big market. We have the Arba'in, which is an event that takes place once a year. It's 40 days. Something like anywhere up to 15, 20 billion people do take part in that. So there is that, but also there is a lot of small groups starting to see there. If you have time, there is a wonderful sort of individual to look for, somebody called Wandering Earl, who organizes with a group of friends that I know here in Iraq, tourism for people. And if you look at those out, you'd be surprised the kind of the number of tourists who do visit Iraq and do have a look at it. But is that anywhere near where it can be? No, it can be significantly large. It will get bigger, obviously, with the more and more the stability of the country sees, more and more that people stop seeing all those horrendous images of traditions you always see in Iraq, and then they see the other part. That I think will accelerate that, but there is a lot to go from there. So I hope that answers you.
Good answer. Nobody probably expected that. Then another question that is for Ruchir. Many economists are projecting a quarter-to-quarter GDP growth for US and Europe to be around 0 for Q1 and Q2 of 2024, and a relative modest GDP growth of around 5% for China for 2024. Will such material economic slowdown relative to second half of 2023 have an impact on the EPS growth and stock valuations for your Asia fund? The sentiment upon such news might be quite negative. I think you touched a little bit on this already.
Yeah, it's a pretty long question, but I can answer in parts. One is on the slow economic growth in the US and Europe in the first half of 2024. So I guess that kind of implies that export growth will weaken in some of our markets. But broadly speaking, many of our countries are not very export dependent, except for Vietnam to some extent, especially, for example, South Asian frontier markets like Bangladesh, Pakistan, Sri Lanka. Their exports as percent of GDP is less than 15% of GDP. It's not very export dependent. It's more domestic driven, more domestic sentiment driven story because of the large domestic markets in these countries. So not very export dependent with respect to that. And also broadly, even Central Asia is not very export dependent from that. It's not like, for example, exports as percent of GDP, for example, in Kazakhstan, Uzbekistan is about between 25 to 35% of GDP. So again, not very large, and again, more dependent on more diverse sectors and more domestic driven stories over here. And also for Vietnam, as I was mentioning earlier, for example, yes, it's very export dependent. But if you look at the export numbers, like Vicente was mentioning, they've seen a recovery in the last 3 or 4 months, and also GDP growth in the fourth quarter was about 6.5 to 6.7%. So seeing a bit of a recovery here. Plus, in 2025, as I was mentioning in my comments earlier, 2023 is a very low base for earnings growth in many of our countries like Bangladesh, Pakistan, Sri Lanka, and Vietnam. So you have a very low base effect anyway. So it's not, it won't be very difficult to get decent earnings growth this year, despite even if there's a slowdown in the US and Europe. And just from a big picture perspective, if US and Europe do see a slowdown, well, that will only accelerate the Fed to cut interest rates, right? Because if they raise so aggressively, and if they kind of see some kind of major slowdown in the US, what historically we've seen is that the Fed then does tilt towards cutting interest rates. And when the Fed does cut interest rates, historically we've seen they cut very aggressively. So they won't cut 25 or 50 basis points in 6 months. If there's a proper recession or slowdown in the US, you can see a pretty aggressive or more a very dovish central bank in the US, and that'll be very important for global sentiment and investor sentiment as well. So I think broadly, the trends in 2024 are quite positive for our market, despite concerns about this slowdown in the US, etc. So I hope that answers the question.
Yes, that's a good answer. Okay, the next question is for Scott. For actually 3 questions from the same person, and I will answer the last one. Scott, what is the PE ratio of the Tashkent Stock Exchange US dollar index? Did you go for the companies with the lowest PE ratio? That's one. Then the next one, what could be a catalyst for a boom of the Uzbekistan stock market? I think that's a very good question. And the last one, why are the costs, and then probably here I think the fees for the Uzbekistan fund higher than the other funds of AFC? So when we launched, whenever we launched a fund, for example, the AFC Asia Frontier Fund, we looked what is in the market around. So we priced the performance and management fee according to what is in the market already available. The same was then for Vietnam, especially Vietnam. There were so many others funds already existing when we launched a fund. When we launched the Asia Frontier Fund, it was the first Asia Frontier Fund launched. And Iraq, there were also a handful other funds, so we also priced the fund according to the other available funds, Iraq funds at that time. And now we're coming to Uzbekistan, and we're very proud of that. We were the first fund launched, and we are still the first fund, so that's why we priced the fund like that. So Scott, now over to you regarding the PE question, and then the catalyst for boom in the Uzbekistan stock market.
Sure. So for the stock exchange index, when we launched the fund, we looked at the index and realized that it had a handful of flaws. One of the big ones is no one actually knows what the constituents are, or exactly what the formula is to figure out what the constituents make up the index are. So really, the index needs to be scrapped. The only reason that we use it as a benchmark, if you will, now in our monthly reports is because people have asked us, is there an index there? The reality is that it's unreliable, and we don't know the companies in it. No one does. So therefore, we don't know the valuation of it. Further, there's been 2 other indexes that have been launched, each with their own flaws. The biggest one is that they're very concentrated in the more liquid names, but still some of the names that they have are very illiquid, and a very small amount of money can push them up double digits in a day. So really, if you want to look at something that most resembles an index, it's the vehicle that is the AFC Uzbekistan fund. So then your other question was
I just moved it away.
Okay.
Yeah.
No problem. In terms of picking companies, we pick companies, and this is the reason we didn't go into the 2 SOEs that were privatized recently. We want the portfolio invest into the companies that give us the best leverage to economic growth, and that's financial services, industrials, and materials at this point, and consumer goods. So telecom, not very exciting. The insurance industry here is very fragmented and has a long ways to go. So we looked at the company, but weren't very excited. So it comes down to companies that give us the best leverage to economic growth, and therefore thereafter we look at valuations. But I believe every one of, say, the top 10 companies in our portfolio has a PE under 10, and it is more or less growing double or triple digits. So the PEs are very low. And then in terms of a broad market catalyst, really it's fixing the plumbing. It is, I've said ad nauseum before in our updates, it's fixing the plumbing for the markets, making it easier for foreigners and locals to open brokerage accounts with this tax incentive, doing some marketing to let Uzbeks know it exists. Because the problem in a lot of frontier markets is legislation is passed, but it's not marketed well, and therefore, it sits on the books as law, but no one actually knows it exists, which is an opportunity, but also a challenge. So these things are the big ones, and then of course the passing of the capital markets legislation, which is sitting in Parliament right now. But it won't take a big amount of money to move the markets, as we've seen before in 2020, 2021.
Okay, great. Thank you. Then, Vicente, two questions for you. What is the likelihood of Vietnam to be upgraded as an emerging market after the review in September 2024? And then follow question, any rough estimate of the share of capital flying out of Chinese stocks and being captured by Vietnam? Probably difficult to answer this.
Thank you very much for the question, Anton. As my understanding, right now the government is really trying hard, really hard. They are working with some international institution to meet all the conditions, to meet on the requirement from them to upgrade the Vietnamese markets from the frontier to emerging. And as I understand, right now they are working about the pre-funding, and if they can meet the pre-funding requirements, the market could be upgraded to emerging market within this year. And this is what my expectation. I do not know, but they are working very hard, and they went to the pre-funding issue already. And according to many broker estimation, if Vietnamese market can be upgraded to emerging market, roughly around $5 to $6 billion can be pour into Vietnam every single year. So that's a huge amount. But regarding to the estimated share of capital flying off Chinese stock, I do not know. Maybe I don't have those kind of how to say statistic number, but yeah, some broker they estimate around 5 to 7 billion maybe pour into Vietnamese market. So
yeah,
that's
but we can say the last couple of months we have not seen a lot of inflow from foreigners, so it's very minimum so far. Yeah, we are still waiting for that. Yeah, isn't it?
Yeah.
Okay, great, thanks. Then it's already pretty soon 10 o'clock in Hong Kong. So last question, it's to Ruchir. Hi team, regarding the AFC Asia Frontier Fund, what do you ascribe the relative poor performance of the various non-AFC Frontier funds and MSCI Frontier indices in 2023, apart from talented stock picking on the part of AFC? Thank you very much. One might assume all boats lived in a rising tide to greater or lesser extent. Ruchir, what's your
Yeah, thanks.
take
I
on
mean,
here?
thanks for the question. So I guess the question refers to the outperformance for the Frontier Fund against the benchmarks in 2023. So yeah, it was a pretty strong outperformance. But if you just one is, of course, like I mentioned, it was driven across. It was broad-based performance from many of our key markets like Iraq, Kazakhstan, Pakistan, Sri Lanka, Vietnam, Georgia, etc. And the stocks we hold in those countries also did very well. So yeah, a bit of luck and a bit of good stock picking over there. But broadly, if you look at the indexes, I mean, for example, if you look at the MSCI Frontier Asia Index, it consists of Vietnam, Bangladesh, Pakistan, Sri Lanka. And Vietnam is about 85% of the index. So, when Vietnam doesn't do very well, the index underperforms, and Vietnam does very well, then the index goes very high. Plus, if you look at the MSCI Emerging Market Index, China has I think, pretty high weight. China obviously underperformed last year, so there was, underperformance from the MSCI Emerging Market Index. and also MSCI ASEAN index, I think, or the other indexes also, some of the larger markets in the region didn't do so well. So that led to outperformance by the fund. And as you saw, also the Asian frontier markets, the indexes in these countries also did very well. So for example, Sri Lanka was up almost 50% in dollar terms, Pakistan's up about 25%, Kazakhstan's about 30%, and Iraq was up about 97%. So even just from a stock standalone country perspective, these countries did very well compared to some of the other markets in the region, which were up, but up like 5-6%, and some were even down. For example, Thailand, Philippines, Malaysia, China were all down last year. So that kind of shows strong absolute performance and also relative performance versus the other markets. So I hope that kind of answers the question, I guess.
Yes, it does. Thank you, Ruchir, and thanks everybody. This concludes our webinar today, and since we still had some unanswered questions, we will answer them directly by email, and if you have further questions, you can always reach us by email. I hope you enjoyed this webinar. We will continue to hold quarterly webinars in the future, and we will announce them in our upcoming monthly newsletters. Good night to our participants in Asia, and to the others, enjoy the rest of the day. Thank you.